Hi everyone, I'm David Scranton, and thank you for watching this video because today we're talking about the markets, and we've seen soaring inflation, supply shortages, and rising interest rates, not to mention the nonstop volatility. So here to break it all down, we have Jeff Small, president of Arbor Financial Services, a retirement income store located in Melbourne, Florida. Jeff, always great to spend time with you, my friend.
Great to be here, Dave, with you both, actually.
And also to bring in today's special guest, Jon Najarian. He's an options trader, and he's co-founder of Market Rebellion. He's also the co-author of the book, Follow the Smart Money. Jon, great to have you here, and it's kind of unusual to see you here when we're not interviewing you from an airport somewhere, right? To what do we have this pleasure?
Well, it's my pleasure to be here, guys, and it's an awful lot nicer rather than having all the background of people walking by and noise to be able to sit down and hear you both so clearly. So thank you. It's great to be here.
Awesome, Jon. Great to see you again. Hey, listen, as a continuation of our conversation, what a wild ride it's been the last couple of months here. The market has recovered half of its losses already. And believe it or not, there's still an undercurrent of an uptrend in a rising interest rate environment. And why don't you share why that's the case? Because average investors are demystified right now. They need this thing demystified for them.
Well, you guys have done a great job for years and years, not just recently, talking about how rising interest rates, markets have gone up in rising interest rate environments. Now, it's all based on velocity, guys. If we see a massive jump like we saw in, for instance, 2021, when we had a very quick rise in interest rates in the 10-year in particular, and it just exploded to the upside. That's what spooks markets. A slow, steady rise. I'm not saying that we want to see 3%, but certainly pushing over 2 and to 235, 236, and so forth for the 10-year rate. That has not been the impediment that some of the bears wanted it to be, because again, it's about velocity. If it's slow and steady, and then maybe it gathers itself for weeks or months at a certain level, I think the market can deal with it just fine.
So you think the Fed so far seems to be handling it correctly, and that's the reason why the market's rebounded?
Well, I didn't say that. I'm not going to say that, Dave.
Tell us your thoughts.
I don't think the Fed's handled it correctly at all. I think the reason we have runaway inflation is because of both congressional spending, and thank goodness for Joe Manchin, because otherwise they would have thrown another several $1 trillion at the market under the Build Back Better banner. And that would have been pushing inflation to double digits, I think. But I think the combination of the Fed holding rates low for so long without any rise from the Fed for years is why we have the inflation moving up so quickly. But again, the market itself and the bond traders are the ones moving rates up. The Fed's only made 1/4 point move.
Right.
So we've moved an awful lot more than that by the bond vigilantes and so forth, saying, okay, it's not going to be 0.5% or 0.6%. It's going to be 236 for the 10-year. And they've done most of that work, not the Fed.
We'll have to see if the Fed could make it to 2.5 on the Fed funds rate like they did in 2018. Time will tell, right, Jeff?
It will. And so who heard of organic rate movements, Jon? Because we know all that stuff is orchestrated, just like you said. But there is an X factor on the markets, and that's Ukraine and the deglobalization aspects and what could happen in Europe going forward is they might go into a recession much further than anybody realizes because of the disconnect in Russia. And so tell us, how does that affect the S&P 500? Because there isn't a company on the planet that doesn't have exposure today in terms of that stuff. So tell us what you think there.
Well, and that's 100% right, Jeff. Even though I don't invest in Europe, Europe invests in us. They're nearly 40% of all investments in the United States come from Europe, believe it or not. And that's for a host of reasons, not the least of which is liquidity. But also, we can't dismiss Europe as a bloc that buys stuff from the United States, not just invests here, but buys things from us. So the stuff they buy from us has become more and more expensive because the dollar has been moving up like this for the last year, and it's accelerated in 2022. If Europe continues to buy at a similar pace to what they've been doing in the past, Jeff, then we're going to be just fine, even if European equities do what I think they'll do, and that is, just as you implied, have a lot of trouble because they've got a war going on right on their border, and they've got energy prices skyrocketing, food prices skyrocketing, because Ukraine and Russia are the breadbasket of Europe, just as the United States is the breadbasket of the world.
So, Jon, what do you think is the worst case and what do you think is the best case for both the economy and the markets throughout the rest of 2022?
Best case would be that the war ends and we get back to being able to buy nutrients for plants, in other words, fertilizer from Ukraine, because they do an awful lot of that. They also provide an awful lot of uranium, by the way, which is more and more dear because Russia, even if the war ends, unless Vladimir Putin is taken out, when the war ends, those sanctions will stay in place for a long time, which means Russian energy, Dave, won't be available. Russian nutrients, again, for crops and things won't be available. And I think that will continue to have a negative effect. But the best case is the war ends and Europe gets back to basically rebuilding their own infrastructure for energy, as well as to keep themselves more independent on the food structure. The United States is certainly independent, both energy-wise, if we choose to be, as well as food, but Europe is not. So the negative is that this impacts Europe very negatively for perhaps several years, again, because I don't think those sanctions are just off with the snap of a finger.
So, Jon, on that note, we've got about 60 seconds left. Tell our investors and our viewers and our listeners what sectors they should avoid and what sector is the worst right now and which sector is the best in this environment. What do you like and dislike?
Well, I mentioned them already, sort of. Uranium, so CCJ and UU are two plays that I am in, full disclosure. I own both of those stocks because Germany was going to shut down their nukes, Jeff, and now they're not. They've shut down all but 6. But now they're going to keep those 6 open because otherwise they wouldn't have enough energy to keep their houses with electric power rather than some of the gas that turns turbines from Russia. And I think overall, energy is going to be a space that you want to own for years. It won't always hover around 150, which is my target, but I do think we get there and it holds higher in Europe than it does in the United States. That separation between Brent and WTI could be pushing out to record levels over the next several months.
Well stated, sir. Well stated.
Thank you.
All right, Jeff Small, Jon Najarian, it's great spending time with you both here on The Income Generation. Thank you.
Thank you.
Thank you for watching today's video. If you enjoyed it, click the thumbs up button to give us a like, and make sure you subscribe to our YouTube channel for new content each and every week.